Are you letting the IRS tax you on money that you're giving away to charity? Watch this video to the end to see how you might be able to avoid this. One of the strategies that a lot of tax planners suggest, to clients in order to minimize their taxes is to give money away to nonprofit organizations. Now, please note, disclaimer, we're not teaching you how to evade taxes, But there are legitimate ways that the tax code allows and strategies you to use to be able to minimize your taxes.
It's just being wise with your money.
That's exactly right, So to be able to benefit from charitable deductions, you have to, number one, be itemizing, on your taxes. Itemizing is when you actually break down certain expenses like property taxes and property and mortgage insurance, etc. This is the first place where everyone needs to begin, because when the tax code changed a few years ago and the exemptions went up, a lot of people weren't even able to itemize anymore because they didn't have enough to exceed the exemption amounts.
Yeah, because the standard deductions went
up. Right, exactly right. So let's make sure that you're itemizing, to make sure that you can take advantage of those charitable donations, And once we know that's the case, you have to make sure that you're giving to qualified organizations. Jason, talk to us about that.
Yeah, so you have to make sure that you're giving to a qualified charitable organization, which is classified as a 501c3. And if you're unsure if your charitable organization, the one that you want to give to, is a qualified charitable organization, you can go onto the IRS website, and we'll list the link below so you can check that out.
Once you know that, one, you're itemizing, and two, that you have a qualified nonprofit organization to give to, there's a few different strategies or ways to start taking advantage of charitable giving, And one of them is you could donate to a DAF, what's called a donor advised fund. That's just a fund where you can give money to in a nice, concise way and control afterwards where it goes to. For more information on what a DAF is and how it functions, please go to our video on donor advised funds, Right. But if you establish a DAF, you can actually do a few things to maximize your charitable giving. And one of them is you can donate appreciated assets, such as stocks, into your DAF. And then once it's given away, sell it inside the DAF so you don't have to pay the capital gains on the taxes on that assets, Another way that you can take advantage of charitable giving is what's called bunching or stacking, Now, this is interesting because if you're charitably inclined, you have we talked about the issue of having to itemize, going above, that standard deduction, Well, one way to make sure you do is you say, I'm going to give money to a nonprofit, say my church or a college or whatever it is, But I don't exceed the standard deduction. But if you're going to give that money anyway, what you could do is you can bunch or stack that donation for a couple of years, And say, let's say it's, $10,000 a year for the next 2 or 3 years. You can technically give it all at once in 1 year. Now you would be possibly bumped over that, standard deduction, or give it all to the DAF that year, still spread it out over the next 2 or 3 years, but get the full deduction today because you were bumped above that standard deduction. So those are two different ways to start thinking about how we might take advantage of the charitable contribution and the tax deduction. So Jason, there's a couple of other thoughts you wanted to share.
Yeah, another great strategy is something called a QCD, which is a qualified charitable distribution. So if you have an IRA and you're older than 70 and a half years old, then what you could do is you could give directly from your IRA to a charitable organization. And the thing is with that, though, if you were just to take that money, like especially when you get into your RMD years and you have to start taking that money out, that's taxed at your income tax rate,
right.
But if you give that money directly to a charity, you don't have to pay the income tax on that distribution. Now, as a recorder of this video, the max you can do is $100,000 for that.
Right.
But if you're 70 and a half or older, it can be a great technique, especially if you think about it from the standpoint of, let's say you're already giving, $30,000 a year out of your checking account. Well, maybe you just go over and give $30,000 a year out of your IRA and not have to pay that income tax off it. So a QCD is a great strategy.
You mentioned one thing, which is the 100,000 limit as a recording of this video. And I want to reiterate that there are a few different moving parts because that's based on the tax code, and tax code changes. To be aware of what the limitations are in terms of how much you can give, how much you can actually deduct. For example, as a recording of this video, there's a difference in cash giving versus stock giving and other hard assets. I think right now it's about 60% of AGI from cash giving, and generally you can deduct up to 30% of AGI on current market value of appreciated stock. So I want to drill too deep. Hopefully you have a good CPA or a good accountant that helps you work through that. But just be aware that as you're considering giving, there are certain limitations, but still ample room to be able to take advantage of some of these tax deductions. So Jason, walk us through an actual example of what this could look like.
So let's take Bill and Anna. They're 60 years old, and they're doing a financial plan as they prepare for their retirement. Right now, they make about $280,000 a year, and they're charitably minded, and they're already itemizing their deductions because they have high property taxes and other things that allow them to itemize. Now, the issue when they're doing their financial plan, the financial planner notices that they have a significant amount of Apple stock. So they bought Apple stock a long time ago. That Apple stock is worth nearly $440,000.
Now, this is not a recommendation for Apple stock.
No,
Continue.
Yeah, but their total investment value is $1,750,000. So that makes Apple stock about 25% of their overall portfolio. Now, Apple did really well for them over time, and it grew a lot, and they have a huge capital gain. But the financial planner is saying that's 25% of your overall portfolio, which could cause some single stock risk. And as you enter retirement, you don't want Apple to take a big hit right before you go into retirement and expose you to that risk. So one thought is, okay, well, let's sell Apple and then let's get better diversified. Well, if they sell Apple and they're already making $280,000 a year and they take that huge capital gain, that could push them up into the higher capital gains rate. Right now it's 15%, and the higher rate's 20%. So they would have to pay capital gains tax on all of that in 1 year.
Right.
It could increase their taxes significantly.
Right.
So one thing to think about what they could do, instead of selling all of Apple, maybe they establish their donor advisor fund, their DAF, and then they give a portion of that stock each year into that donor advisor fund. Instead of giving to their church or other charities out of their checking account, they donate that Apple stock into the donor advisor fund, or even portions of it each year, and then they can give that over time through a donor advisor fund. So that's just one example of thinking through, how to a strategy of potentially, how to maximize your taxes or minimize your taxes, actually, and try to be in a scenario where you get the most of your charitable giving. Now, the thing to think about, though, through all of these, charitable giving isn't all about just minimizing your taxes. Obviously, you give to make an impact in this world. But if you're doing the things that we're recommending and you're being wise with your financial decisions on giving, you can save more on your taxes, which actually allows you to give more money.
That's right. And I just want to interject quickly. When you give the stock away, that example you gave to the DAF, you get that deduction, okay? But then you sell it there because it is a nonprofit. There's no capital gains tax paid. So that's where you save all that money and can give more at the end of the day. So we hope this helps. And if it is helpful, please like this video and subscribe to future videos.